Welcome to Dubai Daily, your essential morning briefing on Dubai's real estate market. This is episode 38, 2025 Lessons Learned, What Worked and What Didn't. This podcast is brought to you by Parag Kundalwal, founder and CEO of Consulta, a Dubai-based real estate consulting and global capital advisory firm.
That's right, Daniel. Over the past 2 days, we've celebrated the market's high points. Today, we're taking a more critical look. Understanding both the wins and the losses from 2025 is absolutely essential for making smarter investment decisions in the year ahead.
Let's start with the successes. Several strategies delivered exceptional returns. Early off-plan purchases in emerging master communities were a huge win. We saw developments in Creek Harbour by Emaar appreciate by 15 to 25% from their launch.
And the Oasis master community was another star performer, with properties increasing 20 to 30% in value during construction. The 70-30 or 80-20 payment plans allowed investors to leverage significant assets with minimal initial capital.
It wasn't all about off-plan, though. The mid-market segment, especially in Jumeirah Village Circle, performed exceptionally well for rental yield. Properties bought in late 2024 or early 2025 consistently delivered 7 to 10% gross rental yields. It proved that not all successful investments require a luxury price tag.
Absolutely. On the other end of the spectrum, luxury villas in prime locations like Emirates Hills and Palm Jumeirah also succeeded, appreciating anywhere from 10 to 30%. This was driven by the influx of UHNW buyers and very limited supply.
And we have to mention the Golden Visa. An investment of AED 2 million or more didn't just provide property appreciation and rental income. For many, the tax savings from gaining UAE residency far exceeded the investment returns themselves.
But of course, not every strategy was a winner. Some oversupplied mid-market apartment segments really struggled. We saw price corrections of 10 to 15% where new supply flooded the market, especially in areas far from metro lines.
That's a critical point. Properties in areas with delayed or uncertain infrastructure also disappointed. If a community was promised a metro link that's still years away, appreciation was very limited. The same goes for studio apartments in overdeveloped clusters. A surplus of new units created rental pressure and declining rates.
And one of the biggest pitfalls we saw was investors choosing projects from developers with weak track records. Delays, quality issues, poor management. It created so much frustration and financial stress. The allure of a lower price point often came with a heavy cost later on.
It's a classic mistake, often paired with another: purchasing without considering the total cost of ownership. High service charges, chiller fees, and other hidden costs can drastically reduce your net yield. An 8% gross yield can quickly become a 5% net yield if you haven't done your homework.
Timing was also everything in 2025. Q1 was clearly the best entry point. Prices were more reasonable and incentives were better. By Q2 and Q3, we saw peak pricing and a lot of hype-driven buying.
That frenzy led to one of the most common investor mistakes: following market hype instead of fundamental analysis. People bought into projects based on social media buzz without proper due diligence. Then, Q4 brought a much-needed stabilization, which shifted some power back to patient buyers.
So, looking back, what are the key lessons investors should carry into 2026?
First, quality over quantity. One great property from a top developer in a prime location will always outperform 3 mediocre ones. Second, infrastructure is critical. Proximity to a metro station or a major highway is not just a bonus, It's a long-term value driver.
Third, the developer's track record matters more than ever. With so much new supply coming, developer quality will separate the winners from the losers. And finally, do a comprehensive financial analysis. Calculate your net yield, not just the gross, and always maintain a cash cushion of at least 6 to 12 months of operating expenses.
Excellent summary, Lily. The year 2025 was a powerful teacher. By focusing on quality, established developers, infrastructure, and conservative financial planning, investors can navigate the market with much greater confidence.
And that concludes our look back at the lessons of 2025.
To discuss your personal investment strategy, you can contact Parag Kundalwal at Consulta. The best way is to search for Parag Kundalwal on LinkedIn, visit the website at consultadxb.com, or email parag@consultadxb.com. You can also call directly at +971 58 596 4631. Dubai Daily is here for you every Monday to Friday,